Imagine a world just getting riskier, cyber attacks, climate shifts, global tensions, even just managing people is getting complex. Now, picture a company that actually thrives on making sense of all that chaos for everyone else. Welcome, deep divers, to our look at Aon, ticker AON, a real titan in professional services. Today, we're asking the big question. Is this incredibly resilient, insight-driven company truly wonderful, but maybe not trading at a wonderful price right now? We're going to unpack all our research, pull out the key insights for you. And just so you know, our analysis is based on research dated June 24th, 2025, when Aon closed at $358.34 a share. But before we really jump in, a quick word from Stock Analytics AI. Please do like and subscribe to our YouTube channel. For just $499 a month, members get priority deep dives on tickers. We're actually covering all the S&P 500 stocks in the coming months, so it's a great time to join. Or if you just want a one-off deep dive on a specific company, you can always drop us a super thanks. We really appreciate it. All right, let's peel back the layers on Aon. To really get it, we need to start with the basics. What exactly do they do?
How do they operate? Let's kick things off with Chapter 1, Business Analysis. So what really is Aon? Our sources describe them as a global professional services firm. Think of them as advisors helping businesses handle complex risks and people challenges. And this is really important. They don't underwrite risk themselves. They're not like an insurance company taking on the actual policy risk. Their whole strategy, they call it Aon United, is about bringing all their global know-how to every client. And that's powered by something called Aon Business Services, or ABS. It's like a central engine, streamlining everything globally for efficiency and better insights.
And what's fascinating, really, is Aon's dual revenue model. It's quite robust. They make a lot through commissions. I think it was around 65% of brokerage revenue back in 2022, basically from placing insurance and reinsurance for clients. But then they also earn significant fees, a lot of fees from consulting and advisory work, especially in their health and wealth solutions areas. This mix gives them a really stable financial base. It kind of insulates them from some of the ups and downs you might see elsewhere.
And their reach is just huge, right? 4 main areas.
That's right. 4 solution lines. The biggest is commercial risk solutions. Think property, casualty, liability, cyber risk, all that. Then you've got reinsurance solutions. That's literally insurance for insurance companies. And then health solutions, advising companies on employee benefits, and wealth solutions focused on retirement and investments.
So they're basically everywhere. Almost any industry you can think of. Aviation, healthcare, tech. They have expertise. Okay, but what about their market position? It's not just about the services, it's their sheer size, too. Operating in, over 120 countries, 60,000 employees. They're always ranked up there as one of the world's biggest insurance brokers, alongside competitors like Marsh & McLennan. And you see their influence, like in those Global Insurance Market Insights reports they put out. They're seen as real thought leaders.
That's a key point. Their stated purpose to shape decisions for the better, it actually links directly to their value proposition. They offer clarity and confidence. How? Through actionable analytic insight. In a world that feels increasingly complex, they use their vast data to help businesses make smarter choices. They're selling understanding, really.
Okay, so let's zoom out a bit to the wider industry.
Yeah.
The global insurance brokerage market. It's massive. Over $287 billion in 2023. And it's expected to grow pretty fast, like 9.2% a year, hitting maybe $525 billion by 2030. That's a strong tailwind.
A very strong tailwind. And several big trends are fueling that growth. Digital transformation and AI are huge. You see Aon responding directly with things like their Aon Broker Copilot. They just launched that yesterday, June 23rd. Then there's ongoing market consolidation, which tends to favor the big players like Aon. And of course, there's just growing demand for specialized advice on new risks, cyber, climate change, ESG factors. Businesses need experts for this stuff.
Right. And who are the main competitors in this space? You mentioned Marsh & McLennan.
It's pretty much an oligopoly. You've got Aon, Marsh & McLennan Companies, MMC, and Arthur J. Gallagher, AJG, is the big 3. Interestingly, while MMC might have higher revenues overall, Aon often shows better profitability, particularly if you look at things like return on equity.
Okay. And the industry is heavily regulated, you mentioned.
Extremely regulated, which is a double-edged sword, as they say. It means high compliance costs for Aon, no doubt. But it also makes their expertise in navigating all those complex global rules incredibly valuable to clients. It reinforces their position as an essential advisor.
That makes sense. So if someone wanted to start a competitor today, what are the barriers? They sound pretty high.
Oh, they're immense. Huge barriers to entry. First, the complex global regulations and licensing that takes serious time and capital. Then, building a trusted brand. In this industry, that takes decades. You don't just appear overnight. And finally, Aon's sheer scale, their data access, their long-standing relationships, that creates economies of scale and information advantages that are just incredibly hard for a newcomer to replicate. These are Aon's moats, essentially.
Let's dig into those moats a bit more. What really protects their business long term?
Well, first, their brand. It's synonymous with trust, backed up by industry awards and their thought leadership. Second, the cost advantages from that ABS platform we talked about. Standardizing processes globally really lowers their unit costs. And third, powerful network effects and switching costs. Once a client is deeply integrated with Aon's systems and advice, it's really disruptive and expensive for them to leave. That's why their client retention is so high, near 90%.
And you mentioned data as a key advantage. They invest, what, $500 million a year in digital?
Yeah, $500 million annually. And that's not just maintaining systems, that's driving innovation. It leads directly to things like the Aon Broker Copilot using AI and predictive analytics. It fuels those influential reports. Basically, their vast proprietary data on global risk, combined with these analytical tools, lets them offer insights that competitors just can't match. It's a core competitive weapon.
So putting it all together, it sounds like Aon's business model almost benefits from global uncertainty, the more complex things get.
Precisely. That's the fascinating part. Rising global risks, cyber, climate, geopolitical stuff, these aren't just challenges for Aon, they're business drivers. When the world gets more complex and uncertain, the demand for Aon's core risk advisory and solutions goes up. It makes them incredibly resilient, almost counter-cyclical in a way.
That's a powerful position. Okay, so we understand the business. Now, who's leading this massive, complex organization, and how well are they doing it? Let's move to Chapter 2, Management Evaluation. First thing that jumps out is stability. Gregory C. Case, the CEO, he's been there since 2005. That's nearly 2 decades. And the board isn't exactly new. Either average director tenure is almost 15 years. That suggests a long-term focus. Plus, our sources note that CEO pay seems well aligned with shareholder interests.
Experience is definitely there. But the real test for this management team was that failed Willis Towers-Watson merger in 2021. That was a major setback. Cost them $1 billion in a termination fee, huge regulatory hurdles. But what stood out was their response. They didn't just stumble, they pivoted quickly. They launched the 3x3 plan, focusing on core client needs, and then made that big NFP acquisition. It showed real resilience, adaptability.
And what about communication? Ethics seems like they put effort into that too. Code of conduct, ethics helpline.
Yeah, they seem quite structured and transparent. They publish research on things like pay equity, which is proactive. And the board governance looks strong. 12 out of 13 directors are independent. That signals accountability.
Okay, let's talk about how they use their money. Capital allocation.
This is a big one for Aon. They are very disciplined, and it's all driven by return on invested capital, ROIC. Basically, they want to make sure every dollar they invest, whether in acquisitions or internal projects, generates strong returns. They have a history of strategic M&A, but after the big NFP deal, they're talking more about smaller tuck-in acquisitions. And significantly, they've committed $1 billion to AI and advanced analytics, investing back into that core data advantage.
And they certainly return capital to shareholders. Wow, $20.8 billion in buybacks since 2012, reducing share count by 23%.
Aggressive buybacks, absolutely. And the dividend track record is impressive, too. 15 straight years of dividend growth. The 10-year growth rate is over 10%. And the payout ratio is only 23%, which is very low, very safe. Leaves plenty of room for future increases or reinvestment.
So that focus on ROIC, it gives you confidence they're not just chasing size.
Exactly. It suggests they're focused on profitable growth, avoiding those empire-building deals that can sometimes destroy shareholder value. Their historical ROIC, like 30.6% in 2022, backs that up.
All right, we have a good picture of the business and the management. Now let's dive into the numbers themselves. Time for Chapter 3, Financial Analysis. So where does Aon stand financially? As we said, market cap around $77.4 billion, definitely a large cap S&P 500 company.
Right, and looking at revenue, it's been consistently growing from about $11 billion in 2020 to over $15.7 billion in 2024. That big jump in 2024, around 17.4%, was boosted by the NFP acquisition. But importantly, the underlying organic growth, the growth from their existing business, has been in the mid-single digits or even better. That shows resilience. Let me pull up the exact figures. 2020 was $11.07 BBs. 21 was $12.19 BBs. 22, $12.48 BBs. 23, $13.38 BBs. And 24 hit $15.70 BBs. Consistent climb.
And those profit margins look really healthy. Gross margin around 46.8% recently. Operating margin was 23.4% TTM Q1 25. But adjusted for the full year, 2024 was even higher, 31.5%. Net margin around 15.6%. Strong profitability.
Very strong, and they generate a ton of free cash flow. A prodigious generator, as our sources put it. There were dips, like in 2021 with that W2W termination fee, and 2024 due to NFP costs. But the underlying trend is definitely positive and strong. Management's guiding for double-digit FCF growth ahead. Let's see, FCF was $2.06 in 2020, dipped to $1.09 in 21, back up to $3 in 22, $3.02 in 23, then $2.08 in 24 with the NFP costs, but the capacity is clearly there.
Earnings consistency looks good, too, apart from that 2021 dip. An 11% compound annual growth rate for EPS since 2014.
Very consistent compounding, excluding that one-off event. If you look at diluted EPS, $4.88 in 2015, then $5.16, $4.59, $6.37, $8.45 in 2020, then the dip to $5.55 in 21, and then back strong. $12.14 in 22, $12.51 in 23, and $12.49 in 24.
Okay, now what about Jet? The debt-to-equity ratio is 2.26. Is that a concern?
You know, it looks a bit high on the surface, but is heavily influenced by those share buybacks. Buybacks reduce equity, which pushes the ratio up. Given Aon's incredibly stable cash flows, it's not really seen as a major risk. Management has a target leverage ratio they stick to. Plus, their current ratio is healthy at 1.63, so short-term liquidity looks fine.
And we already mentioned the dividend stable, growing for 15 years, low payout, seems solid.
Definitely. Now, turning to valuation, the TTM PE ratio is around 30.7. How does that compare? Well, Marsh & McLennan is lower at 26.8. Arthur J. Gallagher is way higher at 48.5. And interestingly, Aon's current PE is right around its own 5-year average. The market seems to be valuing it pretty consistently relative to its own history.
And to get a sense of intrinsic value, we look at a discounted cash flow model, a DCF. Just as a reminder, that's basically estimating all the future cash the company might generate and discounting it back to today's value.
Right. And our educational DCF model, based on our research, suggests an intrinsic value range for Aon between $325 and $380 per share. Now, key assumptions drive that range. We assumed initial organic growth in the mid-single digits or maybe a bit higher, eventually settling down to a 2.75% perpetual growth rate. And we use a discount rate, the weighted average cost of capital, or WACC, between 8.0% and 9.5%. These assumptions are crucial, of course.
Okay, that covers the core business, management, and financials. Let's move into the second part of our deep dive. How does the market view Aon? Who owns the stock, and what are the biggest risks? Let's start with Chapter 4, Market Sentiment.
It's interesting. Wall Street analysts seem a bit cautious, maybe. The consensus rating is generally a hold or maybe a moderate buy. But the average 12-month price targets are actually higher than the current price, around $397 to $407. That suggests maybe 10-13% upside potential. Still, the range of those targets is really wide, from $340 all the way up to $471. That tells you analysts have pretty different takes, or maybe they think a lot is already priced in.
And recent news seems mostly positive. That new AI tool, the Aon Broker Copilot, got some attention.
Yes, the launch on June 23rd was seen positively, and they continue to get good press for their thought leadership reports, like that recent employee sentiment study.
What about market indicators? Short interest.
Pretty low. Only about 2.38% of the float is shorted. That means not many big players are betting against the stock. The days to cover ratio is around 5, which is also quite low. No signs of a potential short squeeze or anything like that.
But here's something interesting. The share price itself, $358.34, is actually trading below both its 50-day and 200-day moving averages. That usually signals negative momentum, both short-term and longer-term. How do you square that with the positive news and low short interest? Maybe that Q1 earnings miss is still weighing on it.
That's the puzzle, isn't it? You've got these somewhat bearish technical signals contrasting with positive fundamental news like the AI platform launch. It could be just short-term noise, maybe lingering effects from that earnings miss you mentioned. For a long-term investor, this kind of disconnect, sometimes it's an opportunity. The market might be focused on the short term while the long-term strategy is still sound.
Interesting point. Okay, let's shift gears now. Who actually owns Aon stock? Does that tell us anything? Let's look at Chapter 5, Ownership Structure.
Well, institutions dominate. Somewhere between 86% and 90% of the shares are held by big players. Think Vanguard, BlackRock, Capital World Investors, State Street, the usual suspects. High institutional ownership usually signals confidence from professional money managers. And here's a notable one. Berkshire Hathaway owns about 4.1 million shares. Having Warren Buffett's company as a significant holder, that's a pretty strong qualitative stamp of approval for many investors.
What about insiders? Management ownership?
The percentage is low, maybe 1.1% to 1.4%, but the dollar value held by key people like CEO Greg Case and founder Patrick Ryan is still very significant. Their interests are aligned with shareholders. We do see some insiders selling in the records, but our sources suggest most of that is from prearranged 10b5-1 trading plans, often related to compensation, not necessarily a negative signal about the company's prospects. We haven't seen any open market purchases by insiders in the last 3 months, though.
And is the ownership concentrated?
It is somewhat concentrated, yes. The top 14 shareholders control about half the company. Again, Vanguard, BlackRock, Capital World, Mass Financial Services, and Patrick Ryan himself are the top 5, each holding billions worth. While that shows strong conviction, it also creates a crowded trade risk. If sentiment turns, coordinated selling by a few large holders could really move the price.
Okay, makes sense. No companies without risks, though. Let's break those down. Time for Chapter 6. Risk assessment. Let's use a SWOT framework. Strengths, weaknesses, opportunities, threats. Strengths seem clear. Global presence and scale, that diversified business across different risks and solutions, a top-tier brand reputation, and their leadership in data and analytics.
Agreed. For weaknesses, you could point to geographic concentration. Over half their revenue still comes from North America, which carries some regional risk. Just managing such a huge, complex global organization is inherently difficult. That's organizational complexity. And acquisition integration risk is always there when you grow through M&A, like the recent NFP deal.
Opportunities look significant, too. Expansion in emerging markets seems like a natural growth path. The growing need for specialized advice, cyber, climate, ESG plays right into their hands, and continuing to leverage AI and tech, like that broker Copilot, could unlock more value.
Definitely. But then there are threats. Intense competition from Marsh & McLennan, Gallagher, and others is constant. That pressures margins. Economic volatility is a risk. A deep recession could cause clients to cut back on consulting spend, even if core brokerage is resilient. And attracting and retaining top talent is crucial in a people business. Our sources mention maybe 60% of employees are considering job changes industry-wide. That highlights the ongoing war for talent.
How do broader economic factors play into this, like inflation?
Inflation's a mixed bag for Aon. It pushes up their own operating costs, sure, but it also tends to increase insurance claims costs for their clients, leading to higher premiums. Higher premiums can mean higher commission revenue for Aon. The flip side is that higher premiums strain client budgets, so it's not purely positive.
Interest rates.
Higher rates are generally good for Aon's insurance carrier clients, boosting their investment income. That can sometimes lead to a softer insurance market, maybe more competition. But higher rates also increase Aon's own borrowing costs for any debt they carry. So again, it cuts both ways.
Okay, let's talk geopolitics. Using that hypothetical example from our sources, say, new U.S. tariffs in 2025. The projections were negative. Lower purchasing power, slower GDP growth, supply chain issues. How does Aon handle that kind of disruption?
It connects back to what we said earlier about resilience. Yes, broad economic impacts from something like tariffs are a threat overall, but that very instability increases demand for Aon's specific expertise. Suddenly, companies desperately need help with supply chain risk management, political risk analysis, navigating complex trade rules. So while it's a macro threat, it paradoxically drives business directly to Aon. That complexity is their bread and butter.
Fascinating dynamic. Okay, we've covered a huge amount of ground. Let's try to synthesize all of this. It's time for Chapter 7. Conclusion. So, the bull case for Aon seems pretty strong. You've got a high-quality, very durable global leader. They operate in a growing industry, protected by significant barriers to entry scale, brand, data. Their business model is uniquely resilient, even thriving on complexity, diversified revenues, stable management, disciplined capital allocation with big buybacks and a growing dividend, and the financial performance, consistent growth, strong cash flow generation.
That's a fair summary of the bull case, but the bear case raises valid points too. The valuation isn't cheap. That PE ratio suggests the market already recognizes a lot of this quality. There is some macroeconomic sensitivity, particularly on the consulting side during a potential recession. Competition is fierce, always putting a cap on margins. And managing such a massive global entity always carries execution and integration risks.
And recapping the valuation, our educational DCF model put the intrinsic value somewhere between $325 and $380 per share.
Right. So bring it all together. The final verdict. As of our analysis date, June 24th, 2025, Aon's share price of $358.34 sits pretty much right in the middle of that estimated intrinsic value range. Our conclusion is that it appears to be fairly priced. So while Aon is without doubt an exceptionally high-quality business, great moat, strong management, durable model at this specific price, it seems to offer a limited margin of safety for new investors. It really feels like that classic situation we teased at the start. A truly wonderful company, but maybe not trading at a wonderful price right now.
That was our deep dive into Aon. A lot to think about there. Here's a final thought for you, the listener. Given Aon's unique ability to actually benefit from global uncertainty, how might its value change if the world keeps getting more complex, more risky? What does that imply about how you should assess value in a company in today's world? If you found this analysis insightful, please remember to like this video and subscribe to Stock Analytics AI on YouTube. Members get priority deep dives for just $4.99 in your own. We're covering all the S&P 500 stocks. Or drop us a super thanks if you'd like a specific deep dive.
And just a reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.